جلستنا التالية على واحد من أهم الأسئلة المطروحة أمام المؤسسين والشركات النامية اليوم: ما الذي يبحث عنه رأس المال في هذه المرحلة؟ يتناول هذا الحوار أولويات المستثمرين وجاهزية المؤسسين والمؤشرات التي تمنح الشراكات القوية ثقة أكبر في بيئة تمويل أكثر انتقائية. نرحب بسعيد مراد، الشريك المؤسس والشريك الإداري في لونارا بارتنرز، ومعه محاورة الجلسة باولا نوفل، كبيرة المراسلين في CNN Business.
Good afternoon, everyone. Good afternoon, Saeed. I'm going to spare the audience a long, boring introduction, and I'm going to go right ahead and ask you, what does capital want now?
Well, first of all, I'm just going to say thank you for having us here today. It's a pleasure to be here with you. What does capital want? Returns, risk-adjusted returns, profile of investees that can actually allow for proper growth, scalability. That's a very generic response.
Do you think the way that what capital wants has changed over the past few years? Are, for example, investors more cautious nowadays, if we want to talk post-COVID?
I think you can look at this in terms of different dislocations that have happened over time. The evolution of what capital is looking for as a premise in general has shifted. It's the nuancing of investment decision-making that shifts. What capital is looking for is return profiles and maximizing return profiles in general. Obviously, there's developmental capital and other double bottom line type capital, etc. But if we're going to actually just distill it down to the very, very basics, what capital looks for is typically maximizing returns and enhancing return profiles. The dislocations that happen change risk appetite. The general premise is in investing, you need to look for risk-adjusted returns and how you're able to adapt the capital that you deploy to allow it to maximize a certain output. The risk metric going up, such as, for example, over the past month and a half, will change the profile of how investment decision-making is made rather than what capital is actually seeking. And so what the general sentiment, I would say, if we're going to take today, investors are looking for more quote-unquote attractive entry points and deal opportunities. Capital is more scarce. Investment decision-making is done with a lot more caution. Not that investment decision-making in general is without caution, but you'll just find that there's a lot more that goes into it today because there is embedded uncertainty in market environments, the ability to price and underwrite changes and shifts. And so you see that sort of changing.
Also, when you look at startups, how much of it is usually the founder versus the idea itself?
I don't think you can attribute a specific percentage split. I have to say it always has to have both, particularly at the early stage. At the early stage, you need to have very high conviction in who you're backing, their ability to build and scale a business, the relevance of their background, what they've been doing, what they are doing at the moment, and how it all interlinks. And that couples with the business side. How scalable is this opportunity? How much of a problem are they tackling? Is their solution actually one that will deliver a very differentiated return profile, a very differentiated outcome, and lends itself well to scale? Venture capital as an asset class is one that is built on high-scale models. The velocity aspect is important. Acquiring market share, growing the market and growing market share within that market are components that are very important. And so at the early stage, you're not going to have the proof points already existing within the company, but you can actually identify opportunities where there's a very significant market. The approach in which they are tackling and solving for a problem is unique, is actually one that has a high barrier. It gives them an edge. And then the founding team and the team at large, very important aspect. You need to have very, very high conviction because quite frankly, if you're investing at pre-seed or seed, you're going to see businesses pivoting or adapting. The malleability of a founder to be able to maneuver, understand what the market is saying. You take a product to market, the first thing you're going to get is feedback. If you're not receptive to that feedback and you're not able to adjust and adapt a business model, you're toast. You need to be able to actually be flexible, be understanding, respond to market indicators, adjust your business model, and that's what allows for scalability and growth. And that can be adjusting your approach or even adjusting your pricing, the market you're tackling, the geography you're growing in. All these are factors that need to be taken into consideration.
And apart from being malleable, what are other things, or being not malleable, what are other things that are red flags to you when you look at a founder? You say, I'm out, I'm not doing this.
Part of the due diligence process is spending time and getting to know the founders of the leadership team. And within that, there's a very important dynamic that needs to exist. Investors want to feel like they can contribute, add value. They're not specialists, they're not the experts, they're not the ones building the business. Any investor that tells you otherwise is pulling smoke and mirrors. The reality is the investors are there to support the journey, to enable and accelerate the journey, not to build the business, not to drive the business. You can opine on strategy, you can help and support, but you need to believe in the team itself and its capability to drive and grow that business. If that is the case, and if you're not seeing the indicators that indicate that they can do that, that's a red flag. If you see lack of coachability, that's a red flag. If you see arrogance, red flag. It needs to be managed. Confidence and arrogance is a very fine line. You need to be able to manage the two. Arrogance leads itself to lack of coachability, which means not taking feedback, which goes back to the earlier point about the malleability and the ability to pivot or adjust or adapt your business. All of these things are interlinked and interlocked. And then, of course, other red flags are on the business side. A due diligence process is by nature robust. When we start a due diligence process, we always say two things. We promise you speed and we apologize for our rigor. Mm-hmm. We go deep, we will absolutely dive into the nuances and details of a business. We run a very thorough due diligence process. But on the other side of it, there's a very high confidence of our ability to execute the investment and to add value to that investment.
Just on the founder's side, like if we were to go back more than 10 years ago, SpaceX was still a startup. If you were to meet Elon Musk at the time, and he wasn't Elon Musk that we know right now, he had some of those characteristics that you said are red flags. So when did you differentiate between the two?
He had under his belt PayPal, though, which is not a small business. He was one of the early guys in PayPal. The offshoot of the PayPal mafia, as they're known, has created many, many successful entrepreneurs and investors collectively. I don't think that you would find that somebody will represent certain traits in a certain way at an early part in their journey, particularly if it's their first journey. It's important to be able to distinguish between what is confidence and what is coming from a place of authority and a place of knowledge and a place of in-depth conviction versus arrogance, which is unsubstantiated, not backed, no credibility, which can really dislock the two.
And without naming names, of course, what's the most surprising or crazy founder stories you've come across in your career?
How much time do you have?
We have time.
I'll name one just to spare everybody the pain. We've had conversations with, and this is sort of through different parts of my career, had conversations with founders where they would come in and expectations versus reality, the business and what they claim to have built versus the reality of what's actually on the table, completely dislodged. You're talking through examples where companies would come in, it's not proprietary technology, it is off the shelf, it is anything that you, me, or anyone in this room can go and just sort of pay a subscription amount and have that technology available to them. And I'm not talking about the advent of what we're seeing today with Claude, etc. I'm talking pre those days. I'm talking literally store-bought or shelf-bought technology. Coming in and saying, we're the best at this, we're the only ones that can do this globally, and we only have a presentation, yet we're worth north of $100 million. On what basis? How? Why? You need to be able to justify, to build. And by the way, the marks of a great deal, I've always said this, are when both parties are unhappy. You walk away from a deal. If both parties are unhappy, it means that everybody, didn't necessarily concede on what they wanted, but they had to do a little bit of concession, and so it's a mark of a good deal and a good negotiation. Coming in and expecting a $100 million valuation on store-bought tech, and a lack of a product, lack of revenue, and just literally a presentation. Come on, that's one anecdote.
And how important would you say governance is, specifically at the earlier stages?
Discipline and governance are critical. There's a difference in governance when you're talking about the right policies, procedures, approach, and fiduciary responsibility versus, if you're a 3-person organization, you don't need to have a remuneration committee, it's okay. So there's different levels of governance for a publicly listed company, a very large enterprise and organization, or for a startup. And it's important that investors are actually understanding of that. So the early stages, even if you want to come and say it's something as simple as the governance of a board of directors for a company. When first money comes in at the pre-seed stage, is there really a need for formal board meetings and minuting and structuring and maybe not, but the discipline of running board meetings can actually lead to the right cadence on reporting, the right thinking, the right approach, the right accountability towards presenting to your stakeholders, involving them in the process, engaging them, allowing them to come in and try and contribute and add value and be part of the journey. That's why they're investing in an early stage. And so is it important? Absolutely. I think it's mission critical. I think the level in which it gets applied can be different. Again, you don't need to go with board subcommittees and different, boil the ocean and paralyze the business at the very early stage where you need agility and maneuverability. But you can absolutely start to put the right building blocks in place.
So you've seen startups fail if they don't have the proper governance or discipline? Or is it more you can perhaps coach them on it? Or is it something that it's not teachable?
I absolutely think it's teachable. And it's back to the earlier comment on coachability of a founder. It is absolutely teachable. But have I seen a startup fail because of a lack of a certain or specific governance? We can go as far as to say, yes, fraud is technically due to lack of governance, lack of accountability. We've seen businesses in the broader venture ecosystem, if you will, fail due to fraud or due to malpractice or due to poor accounting, etc., which is all predicated on having the right governance protocols in place.
Also, so you have an operator background. How does that change the way you judge founders compared to a purely financial investor? So you have skin in the game.
I've been in their shoes. I know what it takes. I've been in that part of the journey. I've been at the other side of, cash is running low, collection cycles are a problem, payroll is due, and we have challenges on areas X, Y, and Z because of macroeconomic challenge 1 and micro problem 2 with client X. It very much changes when you've had that direct experience and you know what to look for under the hood. And so even when you're running a diligence process, you know what questions to ask, how to probe, how to challenge, but most importantly, you know where to empathize. You know where things are going to be fine, you know where things are going to be okay, and you know how to look for the marks of a truly resilient founding team. You know how to identify that this team has what it takes, they've been through some of these challenges, I understand the operational nuances, what it goes through. It doesn't matter whether you're in e-commerce or B2B enterprise SaaS or AI infrastructure applications. All businesses fundamentally at the end of the day will have similarities, and some of those similarities will sit where you can actually empathize and where you can connect. And for me as an investor, the ability to connect with somebody at an early stage and them knowing that I've been in their shoes makes a big difference in the assessment process.
If you want to look at the other side, how has raising capital from LPs also changed in the last few years post-COVID? Or has it changed at all?
Are we talking in the region or globally?
In the region.
In the region, yes, it's changed. There's been a realization that technology and venture-backed companies can play a big role in shifting how things are done. When COVID hit and the majority of businesses were locked down, people were trapped at home, it is companies that were able to provide food delivery, the food delivery applications, the grocery delivery applications, the logistics businesses that are built with very resilient and strong tech stacks, those that were able to put the technology up to allow for the administration of the COVID vaccines, and they stepped up majorly. They caused a paramount shift in the way in which consumers engaged. Payments infrastructure, digital payments infrastructure, etc., all came in. Prior to COVID, cash on delivery formed the vast majority of all e-commerce transactions. That shifted to digital payments and to the emergence of businesses like your Tabis and Tamaras and so on, that allowed for buy now, pay later, that allowed for different types of engagement with customers and clients. And so the environment has fundamentally shifted, and the need to be able to capitalize those types of businesses became very prominent and necessary. So what happened is you had more allocation, more concentration, more focus on, in general, the venture ecosystem and the technology ecosystem. And that allowed for a shift in approach. So the sovereigns doubled down. A lot of the sovereign entities in this part of the world started to look inward, started to enable and catalyze the startup ecosystems, started to create the right incubators, accelerators, platform models. We're in Abu Dhabi. One of the most successful stories that I've come across is Hub 71 and what they've done, the way in which they've built a true core enabler for the startup ecosystem in Abu Dhabi. It becomes like a beacon and launch pad for all of this. And so all of that focus has happened. Capital is starting to follow. That capital and the focus internally and people looking at their own region and backing their own has attracted foreign capital. And so we're starting to see the right leading indicators towards what makes this region very investable, very attractive from an investment perspective. And so allocation of LPs towards the alternatives asset class, and in particular the venture asset class, has increased. And so this is sort of a general response to the post-COVID world. What's happening today? I think what you're seeing is attractive investment opportunities. Companies that don't need to raise are not in market. Companies that need to raise will have to raise at more attractive terms, which means that LPs want to put money to work. If we go back to your very first question, if returns are important and prioritized. If we're looking at this from an impact lens, we'll have a different conversation. Today we're talking about sort of capital and the returns side of capital.
So looking at 2025, 2026, and the breakthrough with artificial intelligence, more or less, do you think the sectors of interest are changing?
Yes, in short. They have to. If you're not already sort of fully adopting and embracing everything that the acceleration of AI has brought to us, then you're already vastly behind. I keep hearing comments like SaaS is dead. No, SaaS is not dead. SaaS has taken a very different shape. There's B2B AI-enabled SaaS or AI applications that are sold through subscription models, etc. Those are flourishing, doing extremely well, growing tremendously. Companies like Anthropic and Claude and what they've built, that's a subscription model. Can we say that SaaS is dead if you want to consider Claude to be a SaaS product? No, absolutely not. The flip side is if you're not embracing and adopting and engaging properly with the new technology set that's out there, then you're fundamentally behind. The shift with AI is the most paramount technological shift since we moved from web to mobile.
But I have a question. So we know the term greenwashing, but nowadays I feel some companies are AI washing, just putting the word AI in any brief just to gain like.
I agree.
So how do you differentiate if a company is actually implementing proper AI tools to help accelerate its business, or it's just putting the word AI for the sake of it?
There's a very big difference. I mean, if today a founder of a tech business comes in and speaks to us as a venture capital firm or as an investment platform and says, we're an AI business, right? What are you using AI for? We use it to streamline efficiency within the business. No, you're not an AI business. If you tell me that you're actually building, adopting, embracing models, rolling those out, providing on-prem solutions, providing major statistical efficiency through operating language models, through running the infrastructure on GPUs and data centers, we're having a very fundamentally different conversation to you coming in and saying, I'm a travel agency and I use AI to accelerate my efficiency in responding to my clients. Big distinction, big difference. When we assess a company, we don't just look at the commercial and financial side. We look at the technology. We look to understand in depth the technology. We're an investment platform, and I'd argue we're more AI-enabled than half the businesses that we look at, and that should not be the case. We do it for efficiency purposes. I joke, but my colleague Mazen here has become somewhat of an AI expert. We spend a lot of time understanding properly what technology is out there, how it can give us an edge, and then how does that edge superimpose itself onto the companies that we assess.
Is there any sector you wouldn't look at nowadays because of this breakthrough in AI, a sector that you feel is dead?
No. I think it's too premature to make that judgment. I think you need to be open-minded, you need to be able to assess, you need to be able to look. Excluding something because it sits in a specific sector other than excluded in sanctioned sectors or restricted sectors, etc. That's a different value proposition. But I mean, just because of a certain technological, no, we'll take a look at everything. We go in with an open mind, particularly for our first conversation. If it aligns with what we're looking for, fantastic, we deepen the conversation. If it doesn't, we'll apologize and pass.
And do you think nowadays capital is becoming more cautious and conservative rather than looking at big, risky ideas?
I think it depends on who you are. The general answer is environments of uncertainty will breed higher caution in investment decision-making capabilities. And so if we're looking at the past month and a half, yes, capital is likely going to be more cautious. But on the other side of that caution sits vast opportunity, because the deals that are going to be done now are the ones that will probably have the best return profiles or the highest return profiles. And so you're sitting sort of at that dichotomy where you need to be very, 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 very diligent in making that decision. But once you've made that decision, know that you can have a very, very substantial outcome. Companies like Uber, Airbnb, etc., were born in the middle of a financial crisis. So crises, I mean, what's the expression? It's diamonds are formed under very, very, very extreme pressure conditions. And so the reality is when you have a lot of extreme pressure, it can give birth to diamonds.
We'll get back to that point, but I wanted to ask you in terms also at looking at founders, when do you differentiate between stepping in because something is going wrong, or for example, giving the founder their space and not micromanaging day to day?
If you're a minority equity investor, you likely have certain minority protection rights. You don't have full ability to be able to step in, etc. As a company matures and grows, that becomes a little bit more natural towards it. At the initial stages, VCs go in, what are they going to own? 10, 20% of a company. The founding team still owns 80% plus of the business. The vast majority of decision making still sits with that early founding team. And so the earlier you are, the less likelihood there is of that kind of change happening. As the company grows, sometimes the founder is not necessarily the right CEO, and some of the most mature decisions I've seen taken are founders acknowledging we're not a growth stage chief executive officer for a large business. We were great at taking a business from 0 to 1, maybe from 1 to 10, but it takes a vastly different skill set to take a business from 10 to 100. Back to your earlier question on governance, maybe now is, when you're going from 10 to 100, that's where you need to institute certain protocols, certain things. If we're going to talk about IPO readiness, the most sought after late stage role is a CFO that can help get a business IPO ready. Not only to IPO. IPO ready means that you have all the right governance policies, procedures, and protocols in place. It means that you are ready to withstand public market scrutiny, which means that even if you live and exist in a private market, you can be very, very, very robust. But that experience doesn't sit naturally with everybody. It's experience that is gained, that is learned over time, and so you need to bring in the right type of experience and skill set to allow it to flourish. So to your earlier question, when do you step in? It really does depend on what rights you have to be able to step in or not, but it's around the guidance of those aspects, I would say.
If you want to look at the Middle East, North Africa market, so how, first of all, do you compare the startup ecosystem here to more mature markets? So we've seen tremendous activity in the last few years while the global market was, let's say, steady or going lower, but it's still not big in terms of deal numbers, IPOs as well. So how do you compare it? And do you think the region will get to a place that it's more of a mature market, or do you think the focus will still be on the private equity side of things?
It's a journey. It's a journey. The MENA market is still in its early phase. I would argue it's moving from sort of the very early phase into sort of starting to show signs of that first maturity. We've only just had the first VC funds complete their first cycles and sunset. We've only just had the first few marquee exits, etc., the emergence and birth of, excuse me, the first few unicorns. Not that the unicorn is the measure, but just sort of, it's a sign of some of the evolution and maturity and growth that happens within these markets. The reality is, it just takes a little bit of time and it takes a little bit of patience. And we're starting to get there. We are seeing the leading indicators that you would want to see that would indicate towards that maturity, that would indicate towards that growth. And so I think we're at a very, very interesting point. We're at a very interesting inflection point at the moment with the MENA ecosystem. We lag behind markets like Southeast Asia, Latin America by a few years. But it's not fair to compare us to markets like the US, etc., where capital abundance is absolutely huge. You look at some of the rounds that were last raised, recently and announced, particularly in the AI space. They're larger than the entire MENA venture ecosystem for an entire year as a single round and a single investment in a company at one stage. And so we're still behind, but it takes time. The right building blocks need to be put in place. The right infrastructure needs to be set up, which will allow us to then succeed. But we have to be patient, and we have to grow it in a way that, prevents failure.
But do you think the region would be too ambitious to think that they could reach, for example, the European market, let's say, I'm not going to say the American, or it's possible?
It's absolutely possible. It's absolutely possible. I mean, if we're talking MENA, we're talking about a population of about 400 million people. That's not insubstantial. Unified largely through a common language, but also similar cultural nuances, similar indicators, similar macro environments. I'm not saying that you're going to have a superimposed identical approach, but you see a lot of companies looking at, for example, Egypt, Saudi, and the UAE as a trifecta that they want to be able to unlock.
So I wanted to ask you, who do you think is at the forefront? Saudi Arabia, the UAE, Egypt, or any other markets?
I think it depends on what you're looking for. I think each one of the markets has a very strong edge. Each one of the markets has very strong capabilities.
Can you walk us through the top three?
Yeah. So I would argue you have the UAE and Saudi are very, very prominent. You have a lot of very strong talent coming out from these markets, very strong companies emerging from here. Dominating in both of these markets generally leads to commercial success. Markets like Egypt and Jordan have been fantastic for creating and breeding phenomenal talent. There's very strong engineering talent, very strong STEM programs that come there. Lebanon has been producing some incredible talent. The markets may be smaller or may have other macro challenges that would prevent them from allowing businesses in a standalone market like that to create an absolutely massive outcome. But if they're able to expand and cross geography and start to service other markets, then you are seeing some phenomenal success stories.
So you spoke about Lebanon. Post-COVID, we saw a lot of e-commerce startups gaining traction in Lebanon because, Amazon wouldn't deliver, there was the economic crisis. Do you think this was a stepping stone for the startup ecosystem in Lebanon? And do you think it has potential?
I think it was, and I'll even shout out a company I'm not invested in, I'm not exposed to it in any way. I've just been observing the journey from outside. But you would know it, Toters. They've done a phenomenal job. They've cornered and consolidated the market in Lebanon and then expanded geographically. They went to Iraq, and they're now one of the dominant players in Iraq, which is a very sizable, large population market, strong consumer spend, strong capabilities. And so you're starting to see that cross-border happening and those success stories happening. But to answer, was it a stepping stone? Absolutely. They couldn't have grown to Iraq if they didn't dominate the Lebanese market first.
But when we talk about a country like Lebanon, where there is more, let's say, corruption, bureaucracy, are investors way more fearful? Because this is a problem for investors when they want to look at a startup in such an ecosystem. And it's not only Lebanon, it's a few countries in the Arab region.
I won't go specifics in terms of naming countries. What I will say is, in general, you need to be able to underwrite risk. And so there's different risk factors and different risk indicators that you need to be observing, you need to be very cautious with, and need to be very intentional in assessing. If you're looking at an environment where there's a certain macro challenge, a certain sub-layer that you need to be really digging into, then do your job as an investor and dig into it. Unpack it, understand the nuances, understand the potential impact, understand the fallout of what would happen if A, B, and C were going to happen. You need to be able to simulate, understand, underwrite, and then invest.
Which country in the Arab region or in the MENA region you think has a lot of untapped potential when it comes to the startup ecosystem, of course?
You want me to reveal secret sauce? There's a few, actually. I think that looking at markets like, for example, Egypt, a lot of people discounted Egypt because of some of the macro challenges that were happening, yet we're seeing some phenomenal companies being built there and scaling from there to the rest of the region. The UAE was, seen as, for a large part, was seen as sort of a regional market. On the contrary, we're seeing companies born in the UAE scaling and delivering phenomenal results globally. Globally. We've seen, companies in sectors like AI and machine learning for productivity, cybersecurity, you name it, being built out of the UAE as a home and a hub, a talent base that is here, that are servicing clients globally across Europe, US, and Asia. And so there are absolute success stories that can come out here that can be global success stories. Flip side is there's also, if you look at a market like Saudi, it's possible to build an absolutely dominant business purely servicing the Saudi market alone. The purchasing power and the population and everything that sits within it can allow for local champions to succeed. But even then, you're still seeing that cross-border maneuverability and that expansion. And so we're seeing a lot of different geographies where a lot of opportunity is emerging and emerging in strength, but you just need to know what you're underwriting against as an investor. Am I underwriting against a business that I'm looking at in the UAE for them to dominate the UAE market, or am I looking at this as a global play? Do I feel like their ability to cross borders and sell, in the US, is it going to be advantageous? Do they have an edge? Will they be able to differentiate? Those are the things that you need to be able to look at and identify.
Speaking of that secret sauce, also, which sectors do you believe are still untapped here in the region?
In the broadest sense, I don't think there's a quote-unquote an untapped sector. There's very fine minutiae that you would need to dive into within each sector to look at the subsectors and to look at the entire value chain within it to identify where opportunities can sit. I mean, if we're going to be broad in a response, I would say, for example, AI infrastructure. We're not seeing enough that's coming out of here at the startup level. We're seeing a lot of sovereign attention, we're seeing a lot of sovereign investment and a lot of broad-based infrastructure to enable those types of businesses to come through. But we're not seeing enough of that yet stemming through. Do we see enough, for example, on SME lending? I can name tens of SME lending businesses today that exist. Let's take the UAE alone. Is that enough to cover the gap in what SMEs need from a balance sheet perspective to be able to scale and grow healthily? Do the banks need to step in? Should you leave it to the private sector? Should you create partnerships between startups, fintechs, and the banks? I know that the central bank and the fintech team at the central bank have been very progressive at trying to catalyze all this. Is it still untapped? I don't know if untapped is the right word, but is there still opportunity within it? Yes. It needs to be tackled correctly, it needs to be approached correctly, but these things also, back to the earlier comment on having the right foundational building blocks, it takes a little bit of time.
You spoke about the central bank. I wanted to ask you, how important are regulations, especially when we talk about the GCC region, for this ecosystem, specifically also something we've seen in the UAE tremendously, and it's sandboxes. How important are they so the startup ecosystem can flourish properly?
I can only answer you in one way. They're very important. It's mission critical that you have the right guardrails in place to make sure that anything that is being built has the ability to hit the wall but not fail. So those guardrails provide the guidelines of what you can operate within. The sandbox environment allows for growth step by step as you start to build stronger capability, stronger technology, a wider sort of capability, so you don't have a single point of failure, so that you're actually building and constructing your product properly. What that can translate into sometimes is bureaucracy, and that's what we want to avoid. We want to make sure that the environment is fluid enough and malleable enough to allow for that growth to happen. And the sandbox environment needs to have very clear graduation criteria to say, if you hit 1, 2, and 3, you will move from level 1 to level 2 to level 3 and then graduate into a full licensing regime. That is what needs clarity. And I think the central bank here, again, has been very progressive in providing that kind of infrastructure, has been very responsive. The fintech team has been out there, they've been engaging, they've been listening. Look at things like open banking and how much progress has been made within the open banking space, for example, for unpacking under fintech and what they've done there. So there's a lot of success stories that we can take, that we can learn from, that we can say, this is done well, etc. If you look at the regulation that was applied on the digital asset class, and the rollout of VARA in the UAE, first of its kind globally. It was ultra progressive, and it was the right step. And it attracted some of the world's biggest names to come and set up shop here and to set up HQ here. And that's because of the presence of those guardrails that allowed for that environment to become much more attractive from a broader investment perspective.
Also, I wanted to ask you, so in the last month and a half or two, we've seen the attacks here in Saudi Arabia, in Qatar, in Kuwait, and all of this GCC region, and in Jordan and Lebanon, obviously. What does that mean for the deal activity, and what can we foresee for the near future? Will it slow down because of these events, or do you see it picking up after a deal has been done, let's say?
So let me preface this with, I am not a geopolitical analyst, I am not a political expert, and I will never claim to be. I'm looking at this purely from a commercial perspective. It just means that those that do not need to be in market and those that do not want to operate in environments where there is uncertainty around broader decisioning. What does this mean? How is it gonna look like? What will the day after look like? That sort of uncertainty. It's still sort of a little bit ambiguous. And so you will see that people are just going to be a little bit more cautious in their approach in general. From a commercial perspective, that can also mean that there's actually the emergence of opportunity today. Those that are actually willing to transact, those that are willing to move forward, will identify some incredible opportunities. So in general, I think what we've seen, and this is data and fact speaking, there's been a slowdown in volumes. There's been a little bit of a retraction of the capital flows, and companies wanting to raise capital at this very moment because of uncertainty, and that's okay. But we're starting to see a lot more clarity. We're starting to see a lot more visibility into how things are headed. And inshallah, that means more unlock and a return to sort of things moving and going into their normal course.
So I wanted just to follow up on that. So when all of this is said and done, we've seen a lot of news outlets, media personalities try to diminish or attack this region, saying that people have left, the country is empty or the region is empty, which is not very true, to be fair. Once this is done, do you see the investor trust in this region persist and stay as strong, or do you think there will be some hesitancy?
As an investor,
due to the regulations and the setup, because these are going to stay the same even after.
As an investor in this region, I'll speak for myself, we're not flinching. We continue to transact. We closed a deal earlier today. We are not flinching, we are not backing down. We believe in this region. We believe in everything that's being built out here, and we are here for the long term. We did not flinch throughout. We were in our office in Internet City working all throughout. We did not back down. We did not step back for a second. I do not think that this is the right time for anybody to be taking a step back and to be thinking backwards. I can only speak about myself. I won't speak about other sentiments, but I can tell you from our perspective, we're here. We believe in this part of the world. We believe in the fundamentals. We believe in the capabilities. And everything that has happened will do nothing but double our conviction to double down on everything we're seeing here.
Saeed Murad, thank you so much for your time today.
Thank you.